Hey there, everyone, and welcome to the Final Bar. It's Tuesday, April 16th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com. In a rainy/sunny Redmond, Washington, we're sort of volatile. The markets are volatile. The weather here in Redmond is volatile. The weather elsewhere is volatile as well. So we give a shout out and wish everyone in the Dubai area well. Our guest today, who is scheduled, Adrian Zadunchik, unable to join us. They're having power outages and everything with severe rain in the area. So wish Adrian safety and well wishes there, and other viewers in the area as well. Hope you stay safe and stay dry as much as possible. We're used to rain here in Seattle, but not that much. That's actually it's actually quite a bit. Seems pretty disruptive. Looking at the market conditions here as we begin the show, overall, it's sort of a choppy sideways day. We have Powell's press conference, a lot of focus on what sort of language we'd hear. The market really not getting shocked one way or the other. It's sort of a sideways choppiness to the major averages. But if you look outside the mega cap names, if you look at some of the other sectors, more red than green. If you'll note, most of the 11 S&P sectors actually finished in the red today. With that in mind, let's get to our market recap. We're going to talk about the overall market conditions. We'll actually also do a segment later talking about cryptocurrencies in a little more detail. Before we get to all of that, though, I do want to share a poll we had going recently. Which industry ETF do you think performs best over the next 3 months? I gave you 4 choices: semiconductors, oil services, biotechnology, and home builders. Now, what's interesting about these 4, biotech and home builders getting the least responses, single digits. And, those are two groups as we go through each of these individually. We think about biotech, this is a group within healthcare, which has not been particularly strong. And I think the reason why I would probably not pick biotechnology, and again, we're looking out 3 months, but still the fact that the relative strength is so consistently negative, this has been very rare that biotech has been in a leadership position. So I'd be hard pressed to select something like biotech. And so you saw a little more improvement of some sort, right? Some sign of accumulation. I think the same could be said for home construction, right? If you look at the home builders, the home builder ETF that we included here, ITB, is breaking below its 50-day moving average this week. This is after a series of gaps lower. You can see a clear bearish momentum divergence, higher highs December into March, lower peaks, excuse me, in momentum during that period as well. That leaves us with 2 remaining options, and I'm actually surprised that semiconductors didn't get more love. It ended up being almost 60% of you said oil services, and I would probably agree. Semiconductors are kind of at that really fascinating decision point right about now, where you could see the argument that that we're finding support at an ascending 50-day moving average. A lot of individual names like a Netflix look very similar to the chart of semiconductors, sort of testing support. I could see the argument that this could be an interesting time to, bet on a reversion back to the upside. But the number one vote getter was actually oil services. And I picked the OIH instead of the XLE. What's interesting about oil services and why energy could be good, it's because it's such a play, of course, a direct play on the commodity space, right? We've talked about the resurgence in commodities. We've talked about gold and silver prices moving higher. And also with a number of my guests recently, we've talked about crude oil prices going higher. I think we still have upside to be had there. And if oil prices are going up, oil stocks tend to be pretty good bets during that environment. Energy, by the way, also out of those 4 that I picked you, probably one of the best pretty much over time in rising rate environments. And as we see interest rates pushing higher, as we see Fed comments suggesting that, inflationary pressures are still prolonged and that we may have to delay cuts or have less cuts in 2024, something like energy probably does well in that environment. Usually energy, one of those sectors that tends to do well in a rising rate environment. So thanks for answering that poll. Don't forget to follow us in your social media outlets so you don't miss the next one. Continuing on here with our market recap, you can see yesterday was all about distribution. Today, all about, I would say, consolidation, right? The market at any point can go one of 3 directions. It can go up, meaning higher highs and higher lows. It can go down, lower lows and lower highs, or it can go sideways. We have this consolidation phase, and that's what we're seeing with the S&P 500 today. S&P down about 0.2%, just barely closing above 50-50. That is our line in the sand that we've been talking about for quite some time. I was very intrigued. I don't know if any of my screens, oh yeah, there we go. I was going to say the alert popped up at 9:46 a.m. that the S&P crossed 50-50. So again, the alert engine on Stockcharts is such a great tool, such a great resource to help you stay on top of things, right? Do your analysis on a chart, focus on a particular level or a particular signal, then let Stockcharts monitor that chart for you. And it's literally watching the chart and waiting for the signal to occur. So that happened here when we initially broke down through 50-50. We traded below it a couple times, but at the end of the day, closed just above 50-50 here. We'll zoom in a bit. So overall, staying above our line in the sand, but just barely. We're talking a rounding error above that level. So I think that very much is in play this week. As we expected, we'll continue to monitor that one. For now, we remain above, but just barely. The Nasdaq Composite and the Nasdaq 100, actually the Nasdaq Composite moving lower. The Nasdaq 100, interestingly enough, slightly positive into the close. The Dow actually finished barely in the green as well, with the Dow just below 38,000. You can see mid caps and small caps both underperforming the S&P 500, and the S&P 600 small cap index was down 0.6%. The VIX coming off a bit. Yesterday it was at a 19 handle, so it was 19 and change. Today we're below 19. We're down around 18.4, so almost a full point lower in the VIX. We're remaining above 15, which is sort of that threshold that I think about for a pullback scenario, but we're still below 20, which is my general indication for a corrective scenario. Looking at interest rates, you can see overall the yield curve moving higher today. You can see 10-year yields pushing up a little bit to 466, we'll call it. The 5-year point around 468, the long bond around 476. And you can see the short end of the curve, of course, still elevated. It's interesting when you think about what sectors tend to do well in a rising rate environment. The things that would come to mind looking at the sectors on the left: energy, utilities actually tends to do pretty well. Financials, of course, are usually a pretty decent bet, and then healthcare actually is one of the sectors that tends to do well when rates are going higher. It's actually interesting to see healthcare at the top of the leaderboard. Not a particularly strong stretch here, but it's doing less bad than some of the other sectors we could highlight. Looking at the commodity space, sort of mixed here. You can see the GLD finished up slightly. We'll call it 0.25%, actually 0.1% higher. You can see silver prices down over 2%. Copper prices down as well. Crude oil slightly lower, and sort of mixed results from the rest of the commodity space. It really was sort of a choppy sideways market more than anything here. Finally, with cryptocurrencies, and as I mentioned, we have the Bitcoin halving coming up later this week, expected on Friday. We'll do a segment later in today's show called Crypto Corner. Was hoping to interview Adrian Zadunchik again. Apologies that we can't bring you Adrian's interview. We'll work with Adrian to get him back on as soon as we can to talk about this Bitcoin halving. But I'll share with you a little bit about what it means, what it represents, and we'll look at the chart of Bitcoin together and what we may need to see to indicate a resumption of the uptrend. For now, Bitcoin continuing to drift lower, right? Bitcoin below 63,000 today. It's down 1.3%. Ether prices holding above 3,000, around 30.50. That's down about 1.5% from yesterday. And you can see the rest of the top 10 coins mostly lower. Now, as we look at the 11 S&P sectors, you can see technology, healthcare, consumer staples slightly higher, and that's as good as it got. The XLK was up 0.1%. Everything else flat to down on the day. On the downside, you had some defensive sectors, real estate and utilities, that are both down over 1%. Energy down 0.9% today. Looking down at the Magnificent Seven and Friends, these are the sort of leading mega cap growth names. You can see that they are actually mixed today. Netflix was up 1.7%, about the same for NVIDIA. And what's interesting about both of those charts, we'll hope to look at both of those time permitting. They're all testing the 50-day moving average. This is a common phenomenon right now with some of these leading growth names, a lot of indexes as well. They're sort of breaking through or testing that 50-day moving average. Some of the top ranked scooter names right now are in that condition as well. Microsoft was up as well. On the downside, Tesla continuing to feel the pain here, down almost 3%. Apple and Alphabet both down as well. Let's go to a daily chart of the S&P 500 and see how things played out here. You'll see that line in the sand that remains stable. It remains unbroken, but it does remain slightly violated, I guess, with the S&P tripping below 50-50 during the day today. But by the end of the day, actually closed just almost right at that level. Now, that's the line in the sand that we talked about because it's what we call a pivot point. A pivot point is a classic technical approach where you think about resistance and support sort of revolving around a similar level. Now, pivot points as a technical indicator is a different thing. We actually have the pivot points built into our platform. I remember on the floors of the exchanges in Chicago, back when the floors were active and there were traders there, would note pivot points on an index card or something and have them on the in the pit with them, just to think about key levels during the day. Now, those are short-term pivot points. When I'm using that phrase here, I'm talking about a level of support and resistance, a level that has meaning, a price level which we tend to gravitate to for whatever reason. And you can see that 50-50 first came into play here in February, where we traded up to that level early February of this year, pretty strong leading up to that test of 50-50. We then had about a week and a half sort of testing below that level before finally gapping higher and breaking above. Then you can see that that level of resistance became support. And we actually pulled back and tested that as a support level a number of times. So we're right back to that level. We have broken down through the 50-day, which is not particularly bullish. But for now, we're holding that line in the sand. This general strategy I'm talking about of using the line in the sand is something I advocate for and I use very much in my own investing, which is what's a level, and you just focus on one key level. We can apply all sorts of crazy technical approaches, but boil it down to one key level and set an alert for that point, or set a trailing stop, whatever you need to do to focus in on limiting your losses to a particular point. For me, the S&P above 50-50 is at worst a brief pullback and still within a fairly constructive sort of medium-term, long-term pattern. The S&P below 50-50 all of a sudden looks a lot more vulnerable, and you have to get, before you can get to 4,700, you have to break through that first line in the sand. And so that's where I had the alert set. I'm going to re-engage that alert for tomorrow's trading and see if we do break below that level through the course of this week. Now, the momentum is certainly not encouraging here. We have all the signs of a classic market top. In February and March, we moved higher on weaker momentum readings. And now as we have that initial pullback and violate the 50-day moving average, the RSI is below 40, which for me is usually that downside threshold in a bullish phase. We got below 40, and this looks a lot more similar to bearish markets than bullish markets. We'll talk briefly about the 10-year yield. Where is it? There we go. When thinking about interest rates, what you have to remember is, we've talked about rates staying higher for longer. And when you hear about that phrase in the media or in interviews, what they're basically suggesting is that given inflation that continues to remain stronger than expected, right? We haven't gotten down to that 2% bogey that the Fed has discussed and that Chair Powell has referred to many times. That's sort of their target for year-over-year inflationary changes. We remain above that level, and end of last week, we had another reading that was a little higher than expected. And so when that happens, it implies that the Fed is too aggressive if they start cutting rates, right? The inflation has not done what it should do, given the fact that rates have remained higher. That's why the Fed raised rates in the first place, was to get inflation in check. So if it's not getting down to our downside limit, then that probably means we're not done yet, or rates need to remain higher for longer. So for now, even though rates have been relatively elevated here, if you look at the last couple of years, we pulled back from a high around 5% on the 10-year. That was at the October market low for stocks. Pulled back to around 380, and that was at the end of last year. From there, we've rotated higher. The 10-year yield as of today, all of a sudden testing 4.7% here. So we've gone almost a full percent higher year to date in the 10-year yield. So rates are not just higher, they're actually increasing. And so that's a situation that immediately has me thinking, going back to the traditional playbook of what sectors, what types of names tend to do well when rates are going up. And generally speaking, it's more value-oriented sectors like financials and energy, maybe healthcare you throw in there as well. What is also happening, and what's an interesting phenomenon, is when rates have been going up, growth stocks, particularly mega cap growth stocks like Microsoft and Apple and others, have actually done quite well, particularly on a relative basis. I would argue, and I've read some commentary suggesting that the reason is because they have a lot of cash on hand. They're actually very stable companies, and so less vulnerable to rising rates because they're not borrowing a ton at the moment. Obviously, they've got plenty of cash lying around, and so mega cap growth may be in that bucket of types of names that do well in a rising rate environment, at least in the 2024 edition of that particular theme. To finish off our market recap, let's look at a couple individual names. We dug into breadth indicators yesterday, so I won't go through any of those today. If you missed that, make sure you check out yesterday's episode. We did a segment banking on breadth where we dug into a lot of breadth conditions top to bottom. It was a really good exercise. I'd encourage you to review that one again. Looking at some individual names, it's worth noting that the two top-ranked stocks in our stock charts technical ranking, what we call the scooter ranking, our super microcomputer, which is actually number 2 in the large cap rankings, and MSTR, which is MicroStrategy. Now, these are both technology stocks and both obviously incredible runs over the last 6 to 8 months, coming off the October low. Both of these have come off from all-time highs, and now we're both testing their 50-day moving average. You can see SMCI, which topped out around 1,200 or so, came down to find support here or make a higher low in March, and now retesting that support level. It's around 850 or so. And as of today, we're up over 10%, bouncing back above the 50-day moving average. My question, does this hold, right? This is where the RSI tends to pull back in a bullish phase. RSI doesn't tend to get much below 40. It's kind of right at that point. MicroStrategy kind of at the same place, right? We topped out around 2,000. We've come down quite a bit, right? We've come down 800 points on that level. So we're down about 40% off of the highs, a little bit above there. You can see as of today, we traded below the 50-day moving average. The RSI is right at 40. So if this is still a bullish chart, this is right about that time as we're testing the recent swing low, as we're testing the 50-day, when a chart like this probably should work. So when you think about names to focus on to see if we get a buyable pullback, I would say some of these leading scooter charts that are pulling back to an ascending 50-day moving average with the momentum characteristics right where they tend to bottom out in a buyable dip, do they hold there? I think that's the real question. What's interesting is charts like Netflix are kind of doing the same thing here. You can see Netflix, a little bit of a different configuration only because it hasn't had as much of a drawdown as those other two sort of explosive growth names. Netflix is a little more established, but you can see Netflix pulled back to around 600. That's testing the swing low from late March, also testing an ascending 50-day moving average. So when conditions are constructive, when the market is bullish, stocks tend to pull back to an ascending moving average and then find support. And we see additional buyers coming in. The question, I think, for those leading names, do buyers come in? To finish off our market recap, I would just point out there are some names that are struggling a bit. And I mentioned financials tend to do well in a rising rate environment, but some of the money center banks are not doing particularly well this week. Now, a lot of these are earnings names. Financials have now gravitated to the front end of earnings season. We had some of the bigger banks reporting over the last couple of days. Through the remainder of this week, it's a lot more regional banks. But you can see that Bank of America breaking violently below its 50-day moving average today. The RSI blowing through 40 and pushing a little bit lower. That's not a great look on that particular chart. You can see Citigroup closing below its 50-day moving average as well for the first time since early November, breaking below the RSI 40 level as well. Names reporting later this week that I would keep an eye on: Huntington Bank, similar configuration, closing below the 50-day moving average today. We'll see if buyers are able to come in and provide some support there. Keycorp, briefly below its 50-day moving average, also testing the March low. So I think a lot of these charts are kind of at actionable pullback points. And so the question is, do you want to take a chance on those? I personally am way more cautious given the fact the deterioration that we've seen, particularly in breadth indicators. If these levels hold, though, how bad are conditions? The answer is not too bad. So some interesting charts to keep an eye on today and certainly through the course of this week as we get into the meat of earnings season. We're going to continue on here in a moment with the segment called Crypto Corner, but we do want to make a couple announcements first. Number one, we welcome your feedback so much, particularly on this show. The guests we bring on, if there are other guests that we have not had on before that you'd like to see more of or less of, would you let us know with a comment? Also, of course, questions are always welcome. We'll do another mailbag segment soon, and we'd love to answer one of your questions on the show. Email is best, thefinalbar@stockcharts.com. We're on X at FinalBarSCTV, and on YouTube, just drop a comment below the video you're watching, and we'll hope to answer your question in our next mailbag show. Also, as a reminder, I will be speaking at the Money Show's Investment Masters Symposium that's coming up in Silicon Valley. So I'll be in the Bay Area May 7th through 9th. This is an in-person event. If you're in that area or can get to the Bay Area easily, I look forward to seeing you there. I'll be doing 2 sessions. It's a 3-day event with a lot of great discussions and presentations. It's a smaller, more intimate setting, which I really like. I'll be doing a shorter 40-minute workshop and also a 2-hour masterclass called 7 Questions to Ask Before Every Trade. We'll actually share with you the technical analysis checklist that I use. We'll go through some examples together using recent charts. So scan the QR code that you see on your screen or just click on the link in the description and sign up for that event. If you do, please make sure you say hello when you come to my sessions there. To finish off our show today, we're going to do a segment called Crypto Corner. And again, apologies and well wishes to Adrian Zudunchik and others in Dubai that are dealing with some torrential rain at the moment. Something I've been through in different places and never particularly enjoyable. So I wish you guys safety and health. But in place of that discussion with Adrian, who we'll hope to bring on soon, let's talk a little bit about Bitcoin halving. I'm going to show you the chart of Bitcoin just as the backdrop for this discussion. So what is the Bitcoin halving and what does it actually represent? So part of the structure of Bitcoin involves what's called a halving. And what Bitcoin halving means is it's basically a block halving. It has to do with how Bitcoins are mined. If you remember, if you've read about Bitcoin, you remember learning about it at some point, Bitcoin is actually mined, right? You see computers, basically, I'm summarizing greatly here, solving a complex math problem. That's the way that you basically create Bitcoin. And originally, you would get 50 Bitcoin as a block. That's how the blocks were released. There'd be in blocks of 50 Bitcoin at a time. This was early on, like in the 2000 teens, early days of it. Then in 2012, I want to say, was the first halving. So instead of getting 50 Bitcoin as a chunk, you only got 25, and then it got cut to 12 and a half. Then I got continued to be cut and cut and cut. And so there have been a couple of Bitcoin halvings so far. We are right at the precipice of one, and it is based on a threshold. It's every 4 years or a certain number of Bitcoin. I think it was 200,000, 210,000 blocks, I want to say, of Bitcoin. Once those are mined, then the value halves. And that's a way to make sure that it's a more manageable supply. Instead of being an unlimited supply like you have with the US dollar or other fiat currency, it has a limited supply. So it's a lot more like gold than it is like the US dollar. And by doing that halving, you have a scarcity to Bitcoin, which, as you can think about, if you think of economics 101, the less there is of something, the more demand or the more that something is valued, even if demand remains relatively stable, certainly starts to grow. I have a chart actually showing the history of some of these Bitcoin halving events. We've only had, I think, 3 of them in history. The first one was off the left side of the chart in 2012. It's kind of early days of Bitcoin. There was another one in July of 2016. So I have this vertical line in identifying that. Then you have another one here in April, May of 20, I think it was May of 2020 here. Now, if you'll notice, again, think about we're sort of right at the moment, looks like end of this week, we'll have the next halving, which again means the amount that you get for mining Bitcoin is shrunk in half. If you look at what has happened, pretty much 100% of the time, even though there have been initial choppiness soon after, the value of Bitcoin in the next 12 months has actually been remarkably strong. And if you look at the big parabolic rises in Bitcoin just in the last 10 years, which is what I'm looking at here, you can see end of 2016, early 2017 was one of the biggest rallies. That was right after that Bitcoin halving there. You can see mid 21 to early 21, also a huge rally in Bitcoin. So the fact that we're at that structural moment again here this week, implies that we start to get a big appreciation again, because all of a sudden the supply of Bitcoin starts to be decreased in a very meaningful way. Now, how does that structural change in Bitcoin and how it's mined relate to the actual chart of Bitcoin? On the final bar, of course, we're focused more on the technical outlook than anything. Bitcoin has actually been, I would say, in some ways, a very easy chart to analyze. When I think about Bitcoin in 2022 versus Bitcoin in 2023 and now into 2024, just a clear change of character, right? Which is how I always like to describe it. On the left half of this chart, you see a chart in full distribution mode. We're below a downward sloping 200-day moving average. We keep making new lows. We often become oversold. Compare that to the right half of the chart where we're breaking out above key round numbers like 20K, 30K, 40K. We're breaking above those levels after consolidating, right, and finding support or resistance. We tend to move higher. For the most part, we've remained above an upward sloping 200-day moving average. So I would say the longer term sort of thesis, the overall technical configuration is actually quite strong. I run the market trend model that I run on the S&P 500. I run it on other things, including Bitcoin. It's currently bullish on the long term and medium term, bearish on the short term after this recent pullback. So very similar to the chart of the S&P in terms of its technical structure on multiple timeframes. In the short term, as we to wrap up the segment here, as I was looking at the chart of Bitcoin, up until about a week ago, it certainly felt like what I would call a coil pattern. And a coil pattern, or what's called a symmetrical triangle, is when you have a big move and then you have a consolidation. We have a pattern of lower highs and higher lows, right? So remember, an uptrend is higher highs and higher lows. A downtrend is lower lows and lower highs. A coil pattern is a consolidation, right? A narrowing of the range, lower highs, higher lows. And you can see that Bitcoin is sort of revolving around that 68,000 level or so. We had that pattern broken about a week and a half, 2 weeks ago. We actually broke above that coil pattern to the upside, which on the surface is actually quite bullish, right? When you have that consolidation pattern, you're looking to see which way we break, and we actually resolved to the upside. So on that day, I remember thinking, this is pretty bullish. I think Bitcoin goes a lot further from here. It wasn't to be. And if you look in the last week, we've had stocks and other risk assets rolling over, and Bitcoin not immune to that, also breaking down as well. Just like the S&P getting below its 50-day moving average, Bitcoin is also below its 50-day moving average for the first time since, we'll call it mid-February, when it was last testing the 50-day from below. Now, I think when you take a step back a little bit and look at the chart, we have broken the 50-day moving average. We're right at what I would argue is probably a very meaningful support level around 60,000 to 60,300, which would be a big round number like 60K. And if you look through the history of Bitcoin, big round numbers have often had a lot of meeting. That's happened at 40,000, at 30,000, at 20,000, at 10,000 back to the left. You can see a number of times where the price tends to revolve around those key levels, and Bitcoin has certainly been a great example of that. So 60,000 is the next big round number below current levels, but it's also that swing low from mid-March. So when you've had something that has made a series of new highs, we consolidate, we pull back. Does it hold that recent swing low? Does it hold the first Fibonacci level? So if you take the January low and you take the March high, 38.2% of the way down to retrace the way down to that January low, that's around 60,300, which is, again, right, almost lines up perfectly with that low from March. And that's kind of where we're at, the lows for the last week or so. So I would say we're actually testing a key support level. Again, if you look back at the Bitcoin halvings in history, it's been some choppiness in the short term, but 100% of the time, the next 6 to 12 months have actually been remarkably strong. I'm curious if a chart like this is setting up for the next move higher. A lot still to be added on as we review this chart going forward. But I would keep an eye in the short term at 60,000 as support, and also the RSI is right down to where it was in January, the most recent significant pullback. So does that hold as well? It looks similar to some of the other leading growth names we talked about earlier, testing support at the same time. That's our segment, Crypto Corner, focusing on the Bitcoin halving, some of the technical implications of what we've seen recently. And that'll do it for the show. We got to wrap it up with a 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1, the S&P 500 testing the line in the sand. What I love about this sort of approach is it makes life easier. I'm a big fan of things that make life easier and don't make them more complicated. Things that make life easier, in my opinion, are focused on one particular level, one particular signal, that thing that if we break that level, if you see that signal, it tells you something's different. For the last couple of weeks, we've been talking about S&P 50/50, probably actually back since this level in early March when we broke above it and tested it again as support. That becomes a pivot point. That becomes an important level for me. The tactical support for me was 5,200. That's now broken. 50/50 is the level. We traded below it today, and we closed right at that point. We'll see through the remainder of this week a lot of earnings to digest with a lot of different sectors represented, not just regional banks, but some airlines and many others. Do we hold S&P 50/50? And if not, you will hear my tone change a little bit as we talk about the potential for further downside tests. Something like 4,700, I think, is on the table if we're unable to hold 50/50. Chart number 2, we talked about the Bitcoin halving in our segment Crypto Corner. And I mentioned that I run my market trend model on a series of things. This uses weekly data. And if you go to the front page, the dashboard, we have a widget called the Keller Market Model, which I show on my screen on the show, which just summarizes this model on a series of different asset classes. And just wanted to point out, running this model on Bitcoin, long-term bullish since April of 23, medium-term bullish since October of last year, short-term bearish as of a week and a half ago. And so what we've seen is similar to the S&P. The long-term and medium-term trends, I would argue, remain fairly constructive. But in the short term, that tactical time frame, we've broken down a little bit. The medium-term model breaking below zero is where I get concerned about further downside potential. And if that would happen, if you look back at when the medium-term model has turned back positive, it's often been some of the best buying opportunities on something like Bitcoin. That's what I'd be looking for then. Finally, highlighting some of the leading growth names. These aren't the mega cap names, although charts like Netflix are indeed testing their 50-day moving average as well. But I'm highlighting the two top-ranked stocks in our Stockcharts technical ranking, the large cap version of that. MicroStrategy is number one. Super Microcomputer is number two. These are two technology stocks, both testing the 50-day moving average, also both testing the swing low from March. The bull scenario for me involves names like this holding an ascending 50-day moving average and holding their recent swing lows. Charts like this don't hold support. I think this is a dangerous market with downside potential becoming more and more magnified with stocks like this unable to hold support levels. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Again, all the best and stay safe in Dubai with all of the rain. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. Have a good night.